Good morning, everybody who's on the call. Thank you for attending our How to Benefit from Employee Benefits webinar this morning. We're going to be diving into where we over some carrier options in Kansas, some alternative funding strategies and options, and then we will also be going over three things every employer should be doing in anticipation for their upcoming renewal. I know that some of the faces on here you may not be familiar with. So what I'd like to do is introduce ourselves. My name is Mario Rayo. I am a risk advisor for Fee out of the Dodge office. And
yeah, my name's Josh Turner. I'm an employee benefits consultant for Fee Insurance. I've been here for 6 months. Prior to that, I was at a national consultant firm for about 3 years, and then prior to that, I was at a carrier for about 7 years. I was with Aetna, so I gained some good knowledge of the carrier landscape across the state of Kansas and country. So.
Very good. My name is Sarah Sampson. I'm the employee benefits practice leader. And in all full disclosure, this is our first webinar. So we are very thankful that you have decided to join with us this morning. We hope that we share some great information with you and that we give you some very tangible items to walk out of this webinar with. We appreciate the time you're spending with us this morning. If you have any questions during today's webinar, please feel free to chat them in. We will be checking them at the end of the presentation. I will let Mary introduce herself and we'll get things started.
Hi, I'm Mary Trent. I work out of the Dodge City office. My background is basically 40 years of insurance. Not heavily into benefits, but that's what we have Sarah for. We're glad that you all joined us today.
All right. Well, we're going to start the presentation this morning. I'm just going to set the stage for us. So today we're going to talk about how to benefit from employee benefits. Josh and I have the opportunity to speak with several business owners in the community, and we have found some common threads about maybe some confusions that are out there and some just maybe widening the knowledge of what is actually available. So what we'd really like to do is set the stage this morning and talk a little bit about what employees want. So Willis Towers Watson is a large consulting firm, and they do a great job collecting employee information through surveys. And each year they do a very large survey to talk about benefits attitudes. Some very good findings came out of the most recent survey, and I think it's interesting to note that maybe what we think employees want isn't necessarily what they would say they want. And what we have learned from the most recent survey is that 37% of employees would rather receive more substantial benefits than additional salary and wages or bonuses. 42% of these employees would sacrifice additional pay each month for a more expansive health benefit plan. This is a very dramatic increase from just 2013. And to remind all of you, that was right before the Affordable Care Act provisions really did take place in our country. I think the most telling result of this survey is that more than half of those respondents said that their benefits package is more important to them than ever before. And that's driven largely by the desire for greater security. Things have become really uncertain, and trusting your employer's benefit program is something that all of us have relied on, and it's more important than ever before. So for the employers to really support this, go ahead. A few more results. I hear a lot about how I use the term sucks, right? People talk about how their insurance program sucks, and that's a general feeling that a lot of people have had. But really, 70% of those employees surveyed says that their healthcare benefits do meet their needs. That number does change when we are talking to individuals who are using the health insurance, whether they have a chronic condition or maybe they've had their first episode of utilizing healthcare, or for mental health, which is becoming such a huge talking point when we are more isolated than ever before and our human connections have been reduced. 40% of employees feel that the resources their employers provide support their health and well-being. So our wellness programs are working, the vibe of EAPs are working, but really where employees feel like they could use our help is more helping them manage their financial needs. And that is most likely a direct correlation to the fact that insurance premiums continue to increase and the cost of using health insurance continues to increase. I meet a lot of employees and employers who are overwhelmed by the amount of benefit offerings. You can insure anything from your pet to your children to your spouses. There is a lot of insurance available, and oftentimes it's pretty easy to offer. It's just a payroll slot. But nearly 2/3 of employees would just prefer a moderate choices, right? Give them a few things to learn about and pick from there to spend their money on, because having too many options can be confusing. And then we just shut down and we pick something that we don't really understand. So what are employers doing? SHRM has done a great, the Society for Human Resource Management has really been on the leading edge of keeping in tune with what employers are doing and how to keep employers afloat as we navigate the whole idea of COVID-19 and working from home and the uncertainty that health insurance companies are facing moving into this next year. And as employers are awaiting for their renewals, it's important to understand that those will be very difficult for insurance companies to generate because of just the abnormal use of insurance over the last 12 months. But employers really should move ahead and figure out how to allocate their benefits budget, figuring out which benefit programs to offer, and decide how you're going to communicate all of these changes to the employees. So if we just jump into budgets, if you think about health insurance companies and how they've normally determined the rates, they've taken a look at what happened in the last 1 to 3 years, and they try to paint a picture of what the next year will look like. But during March and April of 2020, 55% fewer Americans sought hospital care. And hospital care is generally the expensive care that plans incur. So we've reduced that by more than half. More than 4 million elective surgeries were postponed in our country. I'm sure most of them were needed, but they have yet to happen, or they are starting to happen again. So as health insurance companies try to figure out what it will look like to be a health insurance provider next year, they're considering this. Healthcare facilities and the professionals have experienced a dramatically reduced revenue stream, and they have had increased costs to secure their PPE. So when we think about what they charge for their services, they may be charging more than ever before to help recover from the damage that they incurred during the pandemic. This is a very important point because when we talk about the largest employers in America, I'm talking about those employers with 10,000 or more employees. They are expecting a 5 to 6% increase this year. That's pretty small in the overall scope of recovering a lot of this cost that has either been postponed or diminished. So if the largest employers in America are experiencing a 5 to 6% increase, what does that mean for the rest of the country and the employers who are not large? For most of the employers on this phone call who don't have 10,000 employees, how has your business been impacted by COVID-19? It's a huge part of this year's benefit conversation. Mercer is another consulting firm that does surveys, and they did a pulse survey in June of 2020. And what they found is that 37% of the respondents plan to do nothing different in 2021 than what they were doing in 2020. What I thought was really interesting is when we look down, if they are planning to make some changes, what are they planning to do for 2021? The number one change that most employers are looking at is to expand virtual or telehealth programs. When I first got into this industry, this used to be the nurse line, and it was a very underutilized program. It has been expanding more And you've seen commercial insurance companies like Blue Cross Blue Shield of Kansas start to offer telehealth as part of their general services. And self-funded plans have the ability to add a telehealth program to their benefits as well. Enhancing mental health support, such as EAPs, things like that, they're coming around again. You know, generally when we don't really know how to help our employees with the stress that has nothing to do with their job, we look for things to offer them to show that we're listening and that we care and we support them. I think that looking at EAP providers this year will be a very important benefit for employers. In fact, 25% of employers are looking to add a program like that. If you notice the italicized one there, this is what most people do when they're thinking about how to mitigate cost. We change the plan design, we increase the premiums, we raise the deductible, the copay goes up a little bit. And this is the solution that most insurance companies are providing. If the current plan that you're offering is just too expensive, then you offer a little bit less benefit-rich design, and that generates a little lower premium. But if we think back to employees really needing help managing their finances, going from a $1,500 deductible to even a $3,000 deductible, it's safe to assume that that could really send an employee into a financial tailspin if they were struggling to even manage the rich deductible that is a $1,500 plan. Adding or expanding voluntary services, you know, this is anything from voluntary short-term disability to hospital indemnity, and this is the area that can become really overwhelming for employees. And where I'm sort of disappointed in the results is where you really could help your high-cost claims and those specialty claims seems to be a hard solution, with just 13.5% of the respondents looking to add something to help with those situations. Communications this year will be more important than ever before. FEE is looking on how we communicate to our employees. We have offices around the state of Kansas, and it's becoming difficult to get us to all come into the same office. And with the concerns of COVID-19 and items like that, considering putting people in one big room has taken a new turn. So just a few questions to the audience. What will you communicate this year? Will you be one of the 37% that communicates no changes? That's usually a really positive message and certainly makes it easy for the HR administrators when there's nothing to change. That's a pretty easy open enrollment. How are you going to communicate it? Are you going to dive into the web-based world like we're doing? Are you going to still bring people into the room? Are you going to go more one-on-one? Are you going to automate your enrollment process through some sort of portal or partnership? How often will you communicate? Employees are really interested in what you're doing. And if you are a renewal, if your anniversary date is coming up here in the next 90 days, you can bet your employees are ready to hear what you're doing. How will employees communicate with you? Do you feel equipped to answer some of the questions they may be bringing to you? And how are you going to communicate with your insurance partners? The old method of communicating with insurance partners was to wait until they were ready to deliver their information from you. And if you are a large enough size, you can often get an earlier schedule, right? So most people get their information 60 days out, but as a large employer, maybe you get your information 100 days out. Having a great communication with your insurance company partners is critical in 2021. So we know what employees want. We know what employers are looking to do. So is it working? Is this going to work? Will employers be able to set a trust factor with their employees that lets them know that even though things are uncertain, we feel confident that what we're offering will benefit you and your families? So just a few questions to ask yourself as we move into the final part of the presentation, where Josh will take over and talk about the 3 steps every employer should do and know. Is your current benefit strategy working? We've met some pretty successful employers that have had an easy time heading into 2021 as it relates to insurance. The challenge is, will that strategy continue to work in 2021? Or how will you determine when your current strategy will no longer work? And maybe for some of you, it's time to start thinking, when did your current strategy stop working? When is it that you will not have enough money to pay for the benefits that your employees will depend upon you offering to them? Or when was the year that you had to totally shock your employee population because your strategy became outdated and you didn't respond soon enough? Josh is going to close us out today with where Fee has really come up with what our 3-step plan is. And while it seems very simple, it's not as easy as it sounds. Josh?
Yeah, thanks, Sarah. So yeah, the thing that I will say, number one, what we've got to do is we've got to have a budget. So if we go here to the next slide. There we go. There she is. So as you can see, Kaiser Family Foundation reported that in 2019, the average annual premium for a single employee was $7,188, and for a family, it was $20,576. So you know, for a group of 10 families, you're looking at over $200,000 as a national benchmark. Okay, and this is a way that you could do a little bit of benchmarking as to compare to what the national average is to what you have today. And then if you look a little bit further, the national average employee contribution, so that what the employee was paying on an average was 18% of a single plan and 30% for the family tier. And I think it's just important to kind of drive down, you know, this is a great benchmarking to say, are we doing better or are we doing worse than the national average? But the one thing we want to drive home is creating a budget independent of what your renewal is pretty critical, and it's helpful in driving the process of where we want to go as we collaborate with our clients and helping that budget determine some of the next steps. One of the things that I'll say is, as you listen to Sarah, she mentioned that COVID has stopped or stalled. It has prolonged many inpatient and many elective procedures. So as you think about that, we've seen several of our clients get pre-renewals or get renewals, and their claims loss ratio was just a fraction of what it was last year because their employees are not going and getting those procedures done, but it's going to happen. And so even though many of you, I hope all of you, will see a reduction or a renewal decrease this coming year because of that. If you don't, it's something that we look at and getting creative. If you do, my encouragement to you is don't just utilize that renewal as your budget, because you got to remember it'll be coming back. So those things, looking forward and being proactive about those things, and having the knowledge of what didn't happen this year, but it's going to be coming due to COVID, is going to be pretty critical as you plan. So options. There are many options, contrary to what many know. In many parts of the market or many parts of Kansas, most of the folks that we talk to don't know what else is out there besides Blue Cross Blue Shield. United Healthcare and Aetna have developed very strong networks in the state of Kansas over the last 5 years. I worked for Aetna, which was Coventry, which was Preferred Health Systems. So if you remember the days of old of Preferred Health Systems, they acquired those networks. And so there's some good, strong proprietary networks that you can consider from that perspective, as well as United Healthcare. In the last 5 years, once United Healthcare took over Cessna's business, they gained a lot of market share and they gained a lot of leverage to be able to do a lot of negotiating in the rest of the market in the state of Kansas. So those three, the big three, are kind of your bundled carrier approach. Okay, and as we look down, moving to the third-party service provider options, you can think about this. Blue Cross, UHC, and Aetna all have fully insured, level funded, and partially self-funded options, and fully self-funded options for that matter. If you move down to the third-party service provider, you're going to be looking at a partially self-funded or a level funded option. So I'm going to kind of move down the scale a little bit and say, many of you may be with Blue Cross and you might be fully insured. You're paying a premium today and they're paying the claims, and that's it. They have complete control over everything that's going on. It's easy, right? But if you're profitable, they get to keep it. If you move to the next item down the scale, you have a level funded option, which means you're on a self-funded contract, right, or a partially self-funded contract and paperwork, but it looks fully insured to you from an administrative perspective. There's no tail end liability, and if you're profitable at the end of the year, you get a portion of the profit back. Blue Cross, United Healthcare, and Aetna have those options now, and then you can move on down to that, past that, to a partially self-funded. And let me just be clear. There are right ways and there are wrong ways to go partially self-funded, and I've talked to many people who have said we went down that road before and we're never going back because things blew up. And if that's you, then I would say there's a good chance that you were just set up wrong in the first place. I've talked to groups who got a 60% renewal being fully insured, and I've been able to take them partially self-funded and actually pull more levers and control more of the cost of the risk. And it brings their renewal down to about 12%. So there are things that you can do, but the most important thing that you look at as you're going partially self-funded and looking at third-party service providers, and as I say, a third party, that could be a BML, a Meritain, a corporate plan management. There's a lot of independent TPAs, third-party administrators out there that have access to these partially self-funded and level funded programs. As you look at those independent administrators, the one thing that you want to be fully aware of is the network. It is number one, because, and I'm not just talking about from an access perspective, I'm talking about from a discount perspective, because I've seen networks that range in discount from an average of 22% off of the bill charges on your claims on down to about 50 or 55%. Okay, so if you're thinking, if you look at that, you look at that 22% difference to a 50%, you're looking at a 32% difference or spread in discount. But actually, if you divide one over the other, if you had a 22% discount and you could have had a 50% discount, your claims actually were 56% higher by being on the poorer network. And I have firsthand experience of a client that I gained because they were put on the wrong network. It was a 140 life group, and their claims jumped up $700,000 just by being put on the wrong network. So don't just let your broker tell you had a bad year. Is one thing that I'll say. There are right ways and there are wrong ways, and you got to make sure that you're on the right network and everything is put in the right place. Moving on, your association and co-op programs. There are chamber programs. There are various associations that you can take part of, and we can dive into those at some point too. But there are benefits. There are other things to be aware of with those. So, and the last thing to consider, especially if you're a smaller employer, is the alternative funding options of an HRA, an independent HRA, or a small employer HRA, where small employers might not be offering insurance because they can't afford it, and instead they offer an HRA to their employees that allows the employee and the employer to fund pre-tax dollars so they can go find insurance on the individual marketplace. So those are all things that would be worth considering, but there's a lot of options out there, and there's a lot of ways that you could just dissect those options.
Hey, Josh, we did just get a question.
Mm-hmm.
It says that a broker has suggested All Savers. What is All Savers?
So All Savers is a subsidiary of United Healthcare, right? In that big three right there. And All Savers would be the level funded option that United Healthcare has. So they would be on an ASO or a self-funded contract and paperwork, but you're paying a fixed premium. You're paying a fixed premium just like you would be if you were fully insured. The beautiful thing about a level funded product, and I should have said this, with All Savers, if you're fully insured today and you have under 50 lives on your plan, if you're considered a small group, you're paying age banded rates. So basically, you're not underwritten based off of the health conditions of your group, and that can be beneficial to some groups, and it can be troublesome for some groups if you overall have a really healthy population. But a level funded product allows you to, you would fill out health questionnaires, and it allows you to get considerations for the overall health of your group, and then you get out of the age banded rates. You pay more of a traditional health insurance premium. And like I said, you're on a self-funded contract. So if you're profitable at the end of the year, then you get to share in that profit. And on the flip side of the coin, if you're not profitable at the end of the year and you spent more money in claims than you paid out in premium, well, it's no skin off your back. The insurance carrier has absorbed that risk. So there's no tail end risk and no downside if you take that option.
Yeah, I have just two other questions that have come in here.
Mm-hmm.
This one says, can I just pay my employees to find their own insurance? And maybe I can take that one.
Yeah, that'd be great.
You know, that fits into the alternative funding conversation. So when we're really talking about knowing all of your options, that is an option. And that might be a great option for some people. Because with alternative funding like health reimbursements accounts, and if we're looking up there, that ICRA, which is, I just love how insurance, we make up words. So an ICRA is an individual coverage health reimbursement account, and that does allow employers to give employees money. It becomes non-taxable wages, and it's still a business deduction to the employer. But that's exactly what that vehicle is for. It allows you to provide employees money for them to obtain their own coverage. And then the other HRA that's mentioned, which is sometimes referred to as a QSERA, the Qualified Small Employer Health Reimbursement Account, would allow the same thing. So the idea of, you know, when I got into this industry, they were called cash in lieu of benefits. And they were a very common idea. I either took the benefit program or I got money if I didn't. Healthcare reform made that not as easy. And there have been some recent, in the last few years, they've relaxed some of the legislation and rules around those and have allowed employers to go back to giving employees money to either pay for other insurance or even to go as far to pay for qualified healthcare expenses that they incur. But I really like those ideas because I think they allow an employer to set a budget that isn't dependent upon your health insurance premiums. And if you haven't had anybody really sit down and take a good look at what offering no insurance would look like to your place of business, that's a really important part of the decision making. What would it look like if I just gave people money? Not through wages, right? Because what we're learning is that employees would take a pay cut to have better benefits. So to help keep those things in alignment, to be able to offer employees what they say they want, would really be important to understand that insurance is one way to give employees some security, but we know that they have trouble managing finances and that they would take a pay cut. So maybe looking at alternative funding, if you haven't done that, would be a really great idea. You know, and kind of one of the unfortunate parts about it is that as an insurance company representative isn't going to go through those with you because their goal is to sell insurance. So if we're talking about not selling insurance, you know, finding a partner like Fee to really help understand what those alternative funding risks and rewards would be, I think is more important than ever before. right.
Let's see here. Okay, the third thing that we want to make sure that we do, and we want our clients or that all employers should make sure they do, is to make sure that they're just communicating openly with the employees. If there's one thing I've learned in this industry is that surprises are not fun. And so anytime change is a possibility, having that open line of communication is always beneficial. One thing I'll kind of say is, and what many of us don't really think about, especially as employers, but employees share about, on average, 25% of the cost of care between what they're contributing and deductibles and co-insurance and different things like that. Typically, it's about a 25% employee responsibility and about 75% employer responsibility. And I think many employees don't really fully grasp that. I think there's kind of a culture that has been created where we think we pay our premiums, it goes to Blue Cross, they pay the claims, and that's it. You know, and in all reality, we all have a lot more skin in the game in controlling the cost of our care and what options are available than what we realize. So there's a, and I could go down this huge long tangent, but there's a serious lack of transparency in the marketplace. And if we come together and work on the culture and helping employees come together and understand the impact that they have on the overall cost of care too, it's very beneficial. So that communication and that, especially in helping to develop the culture of your workforce is great. But yeah, again, if you're making changes, if you're looking at making changes, if you're looking at evaluating anything in the market at all, we strongly recommend just keeping that open line of communication with your employees and making sure they have a heads up there. And again, we would recommend looking at all options. This has been a unique year. Obviously, it goes without saying, with COVID and everything going on, it's unprecedented what kind of impact it's had on healthcare and health insurance costs. And so there are many reasons to kind of evaluate everything that you have going on in your plan and making sure that it's still the best fit going forward.
Mario?
I just want to say thank you to everyone for attending our webinar. I really hope that you guys all got something out of this. You will get a survey. We'd love to get some of your feedback about this webinar. And also you can expect a follow-up from either myself or from Josh. I hope that you all have a great day and have a great week. Thank you.
Thank you.
Thank you.
Thanks.